Victor, the world's gone kind of crazy the last few days and weeks. So I think it's a great time to sit down and separate some of the signal from the noise here, given all the geopolitical issues that the world's been facing.
Yeah, definitely. I mean, we've seen things in the Middle East and China, some things going on in the United States as well. And I think, starting off with a lot going on in the Middle East, we've seen a lot of headlines around this. It has implications for oil prices in particular. And so what we saw is Iran conducted a pretty significant strike against Israel, and the Middle East tensions seem to be at an all-time high as far as recent history goes. And there's, some potential fallout to work through from that. And I think it's our job to distinguish, hey, what actually gets impacted when it comes to investments and when it comes to markets. And the good thing is when you're talking about Iran and Israel, and it truly is a tragedy and our hearts go out to everyone impacted by that. But when it comes to U.S. economics and U.S. markets, the positive from our perspective is that not many U.S. corporations are terribly exposed to the Middle East. They're not huge trading partners with the United States. And so our markets are somewhat insulated from these events. We're going to see a lot of headlines across news media, across, market and investment media. But the thing is, besides oil markets, we're relatively insulated from these incidents. And so as things unwind, and if the conflict continues to escalate, we don't expect too much of an economic or market impact over the medium or long term, especially.
Yeah. And so as we talk about these international events going on, whether, wars or stimulus in other countries, it all comes back, like you mentioned, to oil, to commodities. Those international markets for goods are really what that gets translated through, for the most part, to everybody, even if you're not a direct trading partner. And so on that perspective, Iran produces about 4% of the world's oil. And so any kind of disruption to that through an Israeli bombing, through whatever may happen in the future is, has huge potential for the global economy, not just, isolated to the Middle East there.
Yeah, definitely. I mean, if we were to see Israel potentially strike Iran's oil assets, that could cause a significant disruption in their oil supply. So when you're talking about 4% of global oil, that's a pretty material impact. Now, this brings us to the broader situation surrounding oil, gas in the world, but especially in the Middle East. And so let's talk a little bit about OPEC Plus. We've seen some headlines recently around Saudi Arabia. Over the last few years, essentially since COVID, OPEC has intentionally held back oil production in order to keep prices higher. I mean, if that was a necessity under COVID because nobody was using oil, the world was shut down. But even over recent years, they've been trying to keep oil prices boosted. So they've intentionally cut back production. And the, OPEC cartel is essentially, they're regulating prices in this way. Their member countries have to, fall under these, production quotas. And even Saudi Arabia, on top of the production quotas that they put in place, has intentionally cut back their own production because they have such, prolific oil and gas resources in their country. And the thing is, those are set to unwind starting in December. So Saudi Arabia is looking at, really all of OPEC plus policy gets really run through Riyadh. And so they're talking about now finally reducing those production cuts. So in December, they're going to start ramping across OPEC plus 180,000 barrels per day of extra production on a monthly basis until the end of 2025. So you're talking over 2 million barrels per day of daily production that will be online by the end of 2025. And Saudi Arabia is about 83,000 barrels a day ramp just themselves. And so I think kind of going back to the Israel-Iran conflict, if Israel were to strike Iran's oil assets, Saudi Arabia has the capacity to ramp up pretty quickly. We may see a short-term dislocation in oil prices just because oil production ramp doesn't happen overnight. But Saudi Arabia certainly has the capacity to ramp up to displace that offset in supply.
Yeah. And so part of the issue that Saudi Arabia is facing is that even though they've been cutting back production so much, the oil prices haven't gone where they've wanted them to, because their budget is based on about $100 a barrel oil. And so part of that being OPEC member countries that aren't doing their part in abiding by the cuts that have been set in place, namely Russia trying to fund their war right now. So it's not really in their best interest to intentionally withhold oil. And so you have a bunch of, OPEC member countries who are skirting those rules, but also OPEC's share of world oil production is lower now than it was before. The US has become the world's largest oil producer in recent years. And so OPEC doesn't have the same controls over global supply that they currently do. So I think Saudi Arabia is kind of getting to the point where they're tired of missing out on all of these dollars on such an oil-based economy to begin with. And so to try and, their production ramp is partially to help balance their budget, which has, been a big thing for them, but also to try and incentivize those member countries to actually abide by the caps, saying, hey, we can win a price war. We have the production, we have the capacity to just pump and pump and pump until, no one else can compete and drive them out of business. So you're talking about drying up entire countries' oil supply because it's not economical for them to produce anymore. And so they're, threatening to bring oil down to a $50 barrel through, just massive production in coming years if other OPEC countries don't abide by these restrictions.
Yeah, and I think that's the big risk when we're talking about oil markets, because just to your point, I mean, the oil production market has become so much more decentralized. It used to really be driven by these OPEC countries, especially by Saudi Arabia. Now the US is a huge player. Latin America is becoming a big player. We've seen countries like, Venezuela get back involved in oil production, smaller countries like Guyana, who's really ramping production, especially offshore. And you've also got, countries like Brazil ramping oil production. So the thing is, OPEC Plus doesn't have the same kind of control over the global oil market as they used to. And they're getting frustrated that all of these smaller, Western countries in North and South America and the United States are able to essentially ramp their oil production without any kind of, quota being instituted. It's not impacting oil prices the way that they would like to see them go and higher. And that's holding back oil prices from really jumping to that, $80, $90, $100 a barrel that they would like to see. So the threat is, hey, does Saudi Arabia come into the market and say, I'm just going to undercut all of you on price, because their cost of drilling is extremely low. I mean, you basically poke a hole in the desert out there and oil comes springing up. And so that's, as far as a cost control perspective, it's not a lot for them to have to stomach some low oil prices for a significant amount of time. And so that's something that you and I are definitely watching when it comes to global oil markets and how those work.
And so I think we've addressed the supply side of the oil equation pretty well here. And so I think moving to the demand side, one of the biggest lacks of demand that we've seen in recent years has been from China. Coming out of COVID, their economy has been struggling pretty much since COVID. And so they haven't seen the economic activity picking up, which, translates into a lot of oil consumption that they usually have. And so part of that has been, they just announced a new stimulus package recently. That's the latest in a series of smaller ones, this one being substantially larger to the tune of $200 billion plus. And so that, takes several parts, but we're really hoping that can spur Chinese economic growth, because China is just such a big part of the, global economy. And so them being weak has really created a lot of stresses otherwhere in the country, in the world, really now. So that money that they're announcing stimulus for is directed in a few different places, primarily domestic focused. So that's, alleviating their real estate market a bit. They're dropping existing mortgage rates, something that China can do that, the US couldn't, for example. All existing mortgage rates are being dropped by 50 basis points, or 0.5%. They are lowering their short and medium term policy rates, excuse me. And so that, providing more velocity of money through all of this, they're lowering their bank reserve requirements as well, which again just adds to that velocity of money, allowing people to get loans easier, a little bit easier terms around that, just pushes more money out into the economy, as well as providing about $114 billion worth of direct stock purchasing. That's through company buybacks or just direct government purchases of equities. And we've seen that pretty immediately in the Chinese equity markets since they announced that, have ripped pretty well. And so all of this policy is very domestic focused for China. And so we'll really just have to wait and see what of that, if any, really translates into, international stuff, because it's really their industrial sectors and the production of goods and everything that we're concerned about from a US perspective, and other countries, sending them raw materials, because copper prices moved off this as well. But really, we'll have to wait and see in the long term if this domestic, consumer-centric stimulus package really translates into the broader industrial picture.
Right. It really seems that China's target with this stimulus is more focused on kind of financial markets, domestic economy. They're not really trying to ramp, industrialization or production of, say, real estate assets the way that they did in the past. I mean, China's previous stimulus measures included building a lot of buildings, homes, residences that weren't even needed. They were essentially creating jobs, to build this infrastructure that didn't even have an end demand. And we'll have to do a podcast solely on China sometime in the future, because there's some really interesting factors playing into, their demographic change, their loss of population, why their economy really has slowed down the way it has. But the stimulus is really injecting cash straight into their financial system, straight into their asset values. I mean, we saw the Chinese markets jump almost 30% the week following the stimulus action. And so it's really fascinating from just, whenever we're talking about equity pricing or market pricing of assets, what the impact is. When you come back to the oil market, I think it will have some boost in demand, just because you are stirring up that local economy. It's very consumer focused. So if you have more activity going on, while it may not be on the industrial side, you're going to have a little bit more on the kind of consumer side as far as oil consumption goes. But I think this is also kind of a phenomenon that's going around the world right now. We were in a spot where most, developed economies had risen rates to combat inflation, and they were all aimed at cooling economic growth because inflation had gotten so far ahead. And now that most countries are easing monetary policy, getting back to where money is flowing a little bit better, you should see economic activity start to ramp up again into an environment that's going to impact oil prices. So that demand should probably recover as monetary policy gets easier, as stimulus kind of flows a little bit more, and economies kind of find a new equilibrium state.
Yeah. And to that point, really good point to bring up here is that stimulus is, inherently inflationary. And, China's in a nice position now where they've actually had, by some measures, deflation recently. So their inflation picture looks a lot better than the US and really the broader West, mainly because they produce a lot of the goods that were, driving our inflation initially. But, they're in a fairly unique position to provide a lot of stimulus without having to really worry at all about inflation kicking back up, because they honestly probably want it to kick back up by 1% or 2% to kind of get back in that normal growth range that we're looking for. We addressed that on a previous podcast, probably 10 podcasts ago by now, but where a little bit of inflation is actually good for an economy, and China's really missing that right now.
Right. And I think, our goal as investors is to decide, hey, how much of the stimulus is actually going to translate into earnings growth for domestic Chinese companies. I mean, China's been a really tough place to invest over the last, few years, especially since COVID, just because of the, control that the government has over that country, some animosity towards the West, some conflict with international investors. And so for the most part, we've stayed out of China, but it'll be interesting from a Chinese economic growth perspective to see if this stimulus actually creates better corporate earnings rather than just price increase. Because whenever you talk about, or as we talk about the value of an asset, I mean, it usually has to be supported by earnings, or you just have too many dollars flowing at that asset. So, price can kind of increase either way. But if you're talking about, a price to earnings ratio, if you throw a lot of money at something, the price will go up, but that doesn't mean the earnings will. And so to create lasting economic growth or lasting asset value growth, that earnings part of the equation has to increase as well.
Exactly. There is a risk that this is not a sustainable price increase for these companies. Even today, we saw a slight pullback, or I guess last night for China, saw a slight pullback in prices, some profit taking from these measures. So if that profit taking continues, the companies revert kind of back to their, true valuations, then this will all kind of be for naught. But end of the day, still putting money in the pockets of Chinese consumers. So we'll have to wait and see and keep everyone updated as we go along.
Yeah, it's going to be interesting. I mean, we'll be following, especially oil markets, as we always do. It's a huge part of the U.S. economy these days. And just the broader geopolitical, conflicts going on. We've got a lot happening around the world, and some of it more or less impacts U.S. markets and the U.S. economy. So we'll just continue to keep tabs on that, and hopefully share with our listeners, separate, like you said, that signal from the noise and what really matters when it comes to our investments.
Great, thanks.